Hey everyone, this is Grace, and in this video I'm going to break down what a pin bar is and how to correctly spot it on your charts. A pin bar is a single candlestick formation, and it's defined by its long wick and compact body. Actually, there are two variations of pin bars. A bullish pin bar, which has a long lower wick. The wick represents rejection, signaling that buyers dominated the market during that time, and a bearish pin bar, which shows a long upper wick, meaning sellers had control over the market in that period. But before we get into it, don't forget to give this video a like and subscribe to the channel if you'd like to keep getting valuable videos like this one at no cost. I'll see you right after the intro and disclaimer. So, how can you spot high-quality pin bars? To decide if a pin bar is suitable for trading, follow this important guideline. Guideline number 1. Avoid trading pin bars on smaller timeframes. While pin bars appear often on lower timeframes, they tend to be less trustworthy. Let me walk you through an example to make this clearer. Here's the 5-minute chart of the US dollar against the British pound. As you can see, the market is in an upward trend. Right here, there's a solid bullish pin bar. Then comes a bearish pin bar, which suggests that sellers are gaining control and a reversal might be on the way. But that didn't happen, the market continued climbing. Take a look at this bearish pin bar that formed near the top of the bullish movement. You'll notice the market pulled back slightly, then resumed its upward move. It completely ignored the signal. A couple more bullish pin bars showed up here, indicating buyers were still holding control. That should have led to an upward bounce. However, what happened instead was the market pulled back, triggered a stop loss on MetaTrader, and only then moved upward. This clearly shows that pin bars show up often on lower timeframes, but they're less dependable. Crucial insight: pin bars tend to be more reliable when used on higher timeframes. You'll see fewer misleading signals. That results in fewer opportunities, but with a well-planned trade setup, your potential profits can be significant. Guideline number 2. Never rely solely on pin bars. This candlestick setup performs impressively on longer timeframes, but don't assume you can just trade pin bars all day and expect consistent gains. If this is your only entry trigger, you'll quickly find yourself stuck in a discouraging cycle, since it lacks a consistent edge when used by itself. Take a look at this example. This is the daily chart for the British pound against the Swiss franc. As shown, the market is in an uptrend, which tells us that buyers currently dominate the market. The appearance of this bullish pin bar candlestick suggests that buyers remain strong and a bounce to the upside is expected. But here's what actually happened: the market dropped. Now, here's another bearish pin bar that also failed. Although the pattern implied seller strength and potential downward movement, the market did the opposite and moved up. Yet another misleading signal came from this bullish pin bar. The key takeaway here is that pin bar candlestick patterns are ineffective when used alone. Now, a critical question: how can you assess the strength of a pin bar setup? To judge the effectiveness of a pin bar setup, we apply the TLS method, which stands for trend, level, and signal, 3 essential factors. Let me explain further. When you identify a pin bar on your chart, 3 conditions should be in place. First, there needs to be a well-defined trend or market structure. Second, you must have a clearly visible level, typically support or resistance. Third, a clean and distinct pin bar must be present. Let me give you a clear example. Here's the 4-hour chart of the Australian dollar against the US dollar. We'll use the TLS method to evaluate the pin bar setups appearing on this chart. Starting with the first element, the trend. As you can see, the market is strongly trending downward, showing that sellers are currently more dominant than buyers. This is critical to recognize because it confirms that sellers are leading the market, so I'm not focusing on any bullish pin bars at the moment. Instead, I'm only watching for bearish pin bars since the trend is clearly bearish. Now for the second component, the level. There's a well-defined support zone here. The market dropped below it and later returned to retest it, turning the former support into resistance. So now we're working with 2 key pieces of data. 1. The market is trending downward, and 2. Price has retraced to a resistance area that acts as a strong barrier. When buyers pushed price back to this level, a bearish pin bar formed right there. This is what we consider a high-quality pin bar setup because it fits the broader market context perfectly. You'll notice the market made a sharp move downward, followed by a minor retracement, then another sharp move, and again a retracement. The bearish pin bar forming at this significant level signals the end of the pullback and the start of a new impulse down. And as you can see, after that rejection, the market moved sharply lower. Critical takeaway: using the TLS method makes it much easier to spot high-quality pin bar setups because it emphasizes the full market context surrounding where the pin bar appears. Let's review another example. This is the 4-hour chart for the British pound versus the Swiss franc. We'll use the TLS method again to evaluate the pin bars shown here. As seen, the market is in an upward move, which signals that buyers currently outweigh sellers. This insight helps us narrow our focus to bullish pin bars that align with the direction of the trend, while ignoring bearish pin bars. Here's the first resistance level that turned into support, followed by a second one. You can see that after the market pushed past this resistance, it came back and tested it, turning it into support. A pin bar forming at this support level is considered a strong setup because it marks the end of the brief pullback after the breakout and signals the beginning of a new impulsive move. As anticipated, after this reliable price action signal formed, the market moved upward. Now here's a vital observation. Markets trend only 30% of the time and move sideways or range about 70% of the time. That means if you limit your focus to pin bars that appear only during trends, you're missing out on a large portion of trading opportunities. So how do we assess pin bar setups in sideways markets? In a ranging environment, price moves between a defined high and low. The high zone acts as strong resistance that price fails to break through, while the low zone serves as solid support that also holds firm. In this kind of market, quality pin bars are the ones that form near these support or resistance areas. We avoid trading pin bars that appear within the middle of the range. Let me demonstrate. Let's look at an actual chart example. This is the 4-hour chart of the British pound against the Swiss franc. The market here is neither trending up nor down, it's moving sideways, which means we're looking at a ranging market inside a horizontal channel. This is our resistance zone, and this is our support zone. Once you've identified a ranging condition, you should only pay attention to pin bars that appear near either the support or resistance levels, and disregard those that form in the middle of the range. As shown, the pin bars that appeared within the range failed to deliver, but this particular one worked well because the market tends to respond best to such signals when they occur at critical boundaries like support or resistance. I hope you gained value from today's video. If you did, make sure to hit that like button. It truly helps support the channel. And if you're new here, consider subscribing so you never miss out on future content. Thanks for tuning in, and I'll catch you in the next episode.